Hello and welcome back to our channel. Today we're going to talk about the income statement. We'll learn what the income statement is, what it tells us, and how it can help us to further analyze a company's financial performance. On our channel Ask Finance, we cover various financial concepts. So if you want to learn more about the world of finance, please subscribe to our channel. Let's get started. The income statement shows a company's profitability. It gives us good insights into the company's performance, its financial health, and the income statement is expressed over a period of time. So it can be a year, a month, or a quarter. Unlike the balance sheet, it's not a snapshot at a time, but it's more a flow statement. The income statement is one of the three financial statements, one of the three key financial statements that every investor looks at. So today we'll learn more about the income statement, the different parts, and what it actually tells us. So an income statement typically starts with revenue. We then subtract various expenses. So the first expense that we deduct from the revenue is the cost of goods sold. So the costs that we had to produce the products that we sold. So the materials, the labor, the time that we put into it. We then deduct general expenses, so marketing expenses, selling and administrative expenses. They're all under this part. We then subtract research and development costs, also depreciation, interest, taxes, and we end with the net income. So the income statement, as you can see, shows us a company's ability to generate a profit. We see its revenues, and after all the expenses, we can have a look at, is there something left? Will the company have a profit or will it generate losses? This is all easier said than done. So let's fill the income statement with some numbers and it will be way easier to understand. Let's have an example of a company that generated $100,000 in revenue last year. So our revenues are 100,000 and the cost of goods sold were 20,000. $100,000 minus 20,000 gives us the gross revenue, so 80,000. That's our gross revenue. Our general and administrative expenses were 30,000. And our research and development expenses were 10,000. So we had a gross revenue of 80,000, and now we subtract 30,000 and 10,000 gives us an EBITDA. That's probably a word that you've heard before. So EBITDA of 40,000. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Because that's all that we're going to subtract now. So that's the number before we deduct all the other expenses that are now coming. That's a very important financial indicator. Many companies use it, and it's also used for calculating different multiples or ratios. So that's something to keep in mind. Now our depreciation and amortization was 10,000. Well, now we subtracted the depreciation and amortization, in this case I just named it depreciation. So what's left with is the EBIT. And that's 30,000. EBIT, probably also heard before, very, very important. And now you know what it means. It means earnings before interest and taxes. So it's a financial indicator that comes from the income statement. Now we subtract the interest that the company had to pay on its debt, so on bond or loans that the company has. The interest payments were 5,000. And this stage is called EBT. It's not used that often. In our case, it's 25,000. And what it means, basically, earnings before taxes. So on this figure now, that's our basis to calculate the taxes that a company has to pay. And I just assume in our case that the company had to pay a corporate tax rate of 30%. So 30% of 25,000 is 7,500. So the company had to pay $7,500 in taxes. So now finally we can calculate the net income. So the net income is basically the money that the company has left after paying for all its expenses, for all its costs. And in our case, the company was profitable and it generated a profit. So we take the 25,000 minus the taxes of 7,500 and we have a net income of 17,500. So that's very positive. As you can see, let's go back to it. We have our revenue and we then subtract all different kinds of expenses. We take our interest that the company had to pay. From there we calculate the taxes. I'll just put tax rate 30%. And we get our net income. So what is the net income telling us in this case? Well, first of all, the company generated a profit. That's good. We can also calculate the profit margin, which in our case, 17,500 over 100,000. So the profit margin was 17.5%. That's good. But we can use our net income also to calculate other multiples and ratios that you might be familiar with. So let's go ahead and calculate the earnings per share. Let's assume the company is public, it has shares outstanding, and we want to know the earnings per share in order to maybe then calculate the PE ratio, which is the price per share divided by earnings per share. So we first have to calculate our earnings per share. So now you know that the earnings per share, we take the net income number from our income statement. We take this number and divide it by the number of shares outstanding. I just want to add a quick explanation of why the EBITDA and EBIT figures are commonly used to assess a company's financial performance. Well, we saw that, I'll just take that, the EBITDA is here, right? And the EBIT is after the depreciation. Now we see that the net income is heavily affected, for example, by our taxes, by how much taxes the company has to pay. Well, and in order to compare companies with each other, with other companies, with the sector, but also with other companies in the world, in the US, for example, we have a different corporate tax rate than, let's say, in Germany or in the United Kingdom. With a higher corporate tax rate, our net income will be lower because we have to pay more taxes. And that's exactly the reason why analysts and investors often use the EBIT to compare companies, because it's disentangled from the corporate tax rate. Because in the US, you will have a different tax rate than, let's say, in the United Kingdom or in Germany. And since that number affects our net income, we want to compare the company's earnings before interest and taxes, because then we can compare them on a common ground, on a common basis, without too many national and domestic tax rate differences, and that would then alter our net income. So that was a quick introduction into the income statement. If you like this video, if you learned something from it, please subscribe to our channel, please give this video a like, and stay tuned, because we'll cover many more financial concepts. We'll go into the balance sheet, in the cash flow statement, in how to value a company, different multiples. So subscribe. Thanks.